Hello and welcome to the next meeting, one of the first of the two really important ones for the next couple of weeks, and in its implication for the next couple of years. So I made a point last time about yield inversions, and I want to go over just really quickly about that again, just to make sure that we're understanding what I was talking about. So I should say, let me actually say this first. So when I say a yield inversion, what I'm talking about in this context is the opposite of what usually happens. What usually happens is that people have more faith in the short term than in the long term. The reason why, in terms of like bonds, you know, this is talking about guarantees of money at certain interest amounts, which actually is the yield itself from the government that is given to investors that say, hey, I want this and I want a sort of a guarantee. Usually it's less than inflation, so it's not like the best by any means. So anyways, so that's what a bond is in a nutshell. So the reason why people usually have faith in the short term more so than like the long term, the reason why is because in the long term there's more possibility for things to go awry, things to go wrong. And so because of that more availability for things to happen, go off a cliff, people have more faith in the short term. And so what happens naturally is that the yield, so to speak, in terms of, it's not exactly like this, but just to make things simple, what it means is that people have more interest in buying short-term yield bonds or short-term bonds simply than long-term ones. That's just kind of it. So the inverse of that is that people have less faith in the near term and more faith in the long term. So what has happened is a yield inverse. What this references, I think it actually had it on my laptop. Quick pause, actually, really second. Let me go ahead and cite myself on talking about like how many times it's happened before and such. All right, I found it. Okay, so this comes from Investopedia, a pretty reliable source, just like in general terms, just is well known to be pretty reliable. So what it says here from Investopedia about yield inversions is, and I quote, the yield curve, I'm sorry, wrong one, there it is. An inverted yield curve in US Treasuries has predicted every single recession since 1955, with only one false signal during that time. It even predicted the economic downturn that followed the COVID-19 pandemic, but a lot of people think that it was like a luck thing, but yeah, in any case, so what this is looking at, just to make this like clear, this is 10-year, right? The yields, the 10-year yields. Now, something supply and demand, understanding this, that if people are falling out of buying, they're not buying, right? The 10-year treasury yields, treasury bonds, what happens to the yield is it goes up because there's a lack of demand. What this results in is that we have to bump up the yields that we give money back to try to get more interest in the yields, into the bonds, right? So there's this part. This is the 10-year, and I'm going to switch between this one and the 30-year one, and I want you guys to try to notice the differences, right? So here's the 10-year, and here's the 30-year, right? Okay, so a couple things to notice. Check out how steep that is, right? Check out how steep that is. They're both still pretty upwards, and we'll talk about exactly why that is, because their bonds are exiting the market right now. They're trying to get out of everything, but you see the difference between these things. The steeping there is not so severe, and the inclines there are more severe. What this looks like if you were to, this is kind of the best I could really find under like short-term notice, so to speak, but I've seen better before. But what this would look like if you were to map them onto like one another is just really simply that the yields for the 10-year are more drastically upwards than the 30-year, right? Just keeping in mind again, like just looking at how far this goes down, right? Its point is that it's not as steep as or low as the 30-year. And the reason why again is because there is less interest in the 10-year yields, and this causes there is less interest in 10-year bonds, and this causes the yield to be more inclined, and when there are declines, it's less severe. Because again, it's like there's less interest in them, so the yields can only go so far down, basically, right?
And by interest, you mean like people's interest, like demand?
Yes.
Or not like interest like bank
Yeah. Sorry. Yeah, I know. Bad word to use. But yeah, there's less desire for the 10 years than the 30 years because more uncertainty in the near term, which is usually the opposite because people have generally more certainty in the near term because there's more available for things, more availability, potential for things to go awry in the long term, hence why it's usually like that. In any case, and so they've inverted. And again, Investopedia, every single time this has happened, since 1955, there was a recession that happened, with only one exception. Okay, so there's that part. Now I want to go over really quickly, just again, because here we are, talking about it again, why the market is currently crashing. So I'm going to show you guys, I want to show you guys the valuations at some point and understanding that in this context, when we talk about why this market is crashing, it'll be really blatant. I'll show you what it looks like right now. But in any other time that this sort of super bubble that's ever happened, by the way, Jeremy Grantham, so bit of a relevant tangent, if that makes sense. Jeremy Grantham is sort of the OG of investing. He's the one whose investing style actually inspired Warren Buffett. What he has said is that this market, this current market that we're in, is a super bubble. And it's among the bubbles of 1929 and the dot-com bubble. In all those other times, the reason why 1929 crash, the dot-com crash happened, the reason why that happened was because the valuations literally just got too high. This time around, we have a number of different factors that we can look to see not only is it literally just obviously crashing right now, but as well, here are these other factors, and we're going to go over those really quickly. So, and this is just base floor. There are other ones that I'm sure that I'm not even aware of, but here's like several to, speak into the conversation. So, not only is there a yield inversion going on, which has pretty accurately, since 1955 from Investopedia, pretty accurately predicted recessions, but as bonds exist, what they do is they act as hedging against the market. So I want to check this out real quickly. So this is when the COVID crash happened. You can see they shot up really quickly. They stayed up there. This was when the market was like bottoming or trying to get out of it. And you might map this onto like what the S&P 500 does and what did, and like a number of different stocks. And it's like the exact opposite of this. Particularly with like recovery stocks. Check out like Cinemark or the airlines. You'll see this thing in reverse. It'll be up there. They travel inversely to each other. So high at first, it's going down because the market itself, this is the prices for the bonds. It's nothing to do with yields. That's another thing. Don't worry about that. It has to do with bonds, but yields and this. But this is the price of it. Anyways, so this is traveling down as the market is skyrocketing. At this point, something changes, and we'll look at the market breadth as well. And around this point, something changes. All of a sudden, you see, first of all, the bonds acting as hedging against the market. And we'll look at the market breadth as well. It goes down. I'll show you guys that in a second. It's hedging against the market, and now we're here. This is called an exiting. This is an exiting. That's what that is. We can also look at the dollar. The dollar is the exact same thing. This is well-known understanding of how the dollar travels inversely to the stock market. It's the exact same thing. Now, what has happened at this point is not so much an exit out of the currency, but just simply a further hedging. It was out of, again, looking at COVID happening, right? Starts here, it's the most severe in the market. It travels down because the market is going down itself. And right around here, something changes, and now all of a sudden we have this huge breakout for the dollar, and the dollar again travels inversely to the stock market. This is preemptive, or to others say, for the perspective of the stock market is lagging. But again, we're also looking at the crash happening right now. So the point is, though, they're traveling inversely right now, and this is a massive hedge against the market. So that's the dollars as well. Let's see here. Again, a bit different from the bonds, just because of like the nature of them. That the bonds are having an exiting out of the market, the dollar's continuing to hedge higher against the market itself. It's just how they exist, just their nature. But nonetheless, you can see a hedging against the market through both of them. Now we can go ahead and look at. Actually, you know what? I'm gonna first look at the market breadth. So keep this in mind, what this looks like, as well as what the bonds looked like. This hedging against the market. And something changed somewhere around here. Something changed, right? Let's look at the market breadth. This is severe. I've heard this from a number. So this is about a little after 2021, right? A little after 2021. We can even go back here. This is oh, if I can look at that. Oh, there it is. Okay. A little after 2021, right? Right around this area. Same exact thing. We'll look at the bonds. It'll show the exact same thing, right? This is market breadth. So what this has to do with is the percent of stocks above their 200-day moving average. Yep. Anyways, so above their 200-day moving average. This, the rest of this is just like going through our history and stuff. This was the COVID crash that happened right here. What market breadth shows is a weakness in the market, right? When they are below, when a stock is below its 200-day moving average, which, okay, so to really quickly explain a moving average, it just means like, look at the past 200 days. Take the average price of those 200 days, the mean, and here's that point. And then like the next day, there's that point, and it plots them, you know, over the last 200 days. If they're below their 200 moving day average, it means over the last 200 days, that average is above where they're currently at. And if you look at the stock market as a whole, what it can show is potentially is a serious weakness. I've heard repeatedly, and it's really obvious to see why. I've heard repeatedly that the technicals, or you know, to also reference market breadth and other things, momentum averages and blah blah blah. Anyways, the worst that has ever been seen in decades. That's massive. That's massive. If you look through a number of different crashes that have happened, bear markets that have happened, you can see it in small ways. Like, so for example, here's a good example right here. It's a bit flat. The market was a bit flat, a little bit down, but a bit flat. You can see the just for this part right here, the market breadth was seriously declining, right? That's what we look like now. That's wrong. That is blatant, and that is wrong. But that's the market breadth. It's a silent bear market, another exiting out of the market, just like the bonds. Exact same thing. And again, they happened. This started to happen just when the bonds and the dollar were starting to really hedge against the market, right? It's the same exact timing. Something is obviously going on. We know why. And to put a picture to why, let's look at the valuations. I'm going to show you guys right now the here. What this is this is the Warren Buffett indicator, right? By Warren Buffett, okay, that's what that looks like. Massive bubble. Here's dot-com crash, dot-com bubble. That was the biggest bubble since 1929. Here we are. We went to like 200. This went to, the dot-com bubble went to like 145, I believe. Something like that. Anyways, about 145. We went to the very top here, about just maybe slightly under 200. And now we're declining. So again, like, look at the market breadth, look at the bonds, look at the dollar, okay, everything. If there's ever been a time to look at like the situation of like an economy with a stock market and see some really, really bad things that are being shown, and so, from so many different sources, blaring like these alarms, right? It's now. Now is actually that time to be like, yeah, that's happening, that's blatant. You know, like, I'm competent, and I can see that, and it's like, it's not, you know what I mean? Anyways. Massive bubble. The bond market, the smartest market in the world, as it is known, has been hedging against the market for a while, and it has now recently been exiting out of the market. Okay, now let's go ahead and look at the IWM. This is where it shows really blatantly. Here is now the IWM, okay? So this is the, just right down here, right, all the way here on the left. This is the bottoming of the COVID crash. Here it is. Lot of consolidation. This is a lot. This is a classic topping pattern. When you see a lot of consolidation at the top of like a market peak, there's usually like, particularly in retrospect, you can be like, there was a lot of consolidation going on. This is the most blatant it has ever been throughout all of history. I have checked it. Most blatant it's ever been. And there's a crash. There's that little crash. That is a beginning of a crash that goes way further, way further. Just to show you, again, please, when I point to anything, if I point to this, what I want you to see, what I want you to think about when you see this is everything we've just gone over. It is not any one thing, it is the picture, the collective picture. Have your mind focused on the bonds, the dollar, the breadth, the valuations, everything. Oh, and by the way, The war with Russia, massively significant, not very good. Bonds, right? The yield inversion. Yeah, there's a massive war going on with a superpower in the world. COVID is still going on. China just locked down again recently because of a COVID outbreak. We're not done yet. And now also, as a final cherry on top, cycle analysis. Went over this a little bit last time. I'm going to show you again. I went over this a little bit last time, and what I did was I phrased it with the understanding that there is no hard science to the stock market because you're dealing with psychology. And so, if you understand it in a scientific way with a certain methodology, what you will find is a soft science like psychology. Cycle analysis is soft science. It's soft science because it's based on psychology itself. And you see that come through with what the market does itself. So anyways, so there's this guy, his name's Steve Miller. He was on the Chicago Board of Exchange, really well known, right, institution for the stock market. He has over 40 years of experience, and he is really into cycle analysis. So what this shows, here, let me blow it up a little bit. So what this shows is cycles here. You can see them on the bottom here. And you see little cycles too. They come together. When these things come, all of them together, there is a bigger chance for a bigger correction to happen. It happened for the dot-com bubble. It happened for the Great Recession. It happened in 2016 in a little mini bear. And now here we are there. Happening all over again. Picture, guys, picture. Everything I just said. Forrest, I'm looking at you. This is for you, buddy. What is everything I've just been saying, man? Keep it right there. It's real. And so that's it. And again, 1929, right? The dot-com bubble. It's funny. That actually also has cycle analysis. But those things happen because valuations got too high. What do the valuations look like? There they are. Biggest that they've ever been. And again, look at that market breadth. Silent exit. There's a silent exit going on. Silent exit, okay? I hope that's enough proof for you, Forrest. It should be. I'm not gonna lie. Again, let me say this really quickly. Moment of humility. Nothing is with certainty. I'm a philosophy major, I know that. On a very fundamental, it's like very fundamental level. Nothing is for certain, right? But goddamn, can you have some really good reasons to like act, right? Okay. Okay, so this part, let me try to see. Let's actually go over this one first. So Jeremy Grantham, right, OG of investing, okay, inspired Warren Buffett, very, very prolific figure. Here he is in an interview talking about how last year he was saying like, hey, like the market's gonna be like crashing soon. And he's being interviewed again, and by this guy. This happened in January, by the way, when like, if we look at the IWM, this is when it just started like going down out of that area of consolidation. And here he is being asked, are you as certain as you were then, if not more? And here's his answer.
It's in your mouth. You are as certain as you were then, if not more?
I would say clearly more.
And that's his answer. He goes on, it's a good interview. He talks about a lot of stuff. He goes over a few points of the stuff that like we were covering about like market breadth and the bonds and stuff. So talking about the weakness in the market, a lot of different things. But yeah, there's Jeremy Grantham with a confident smile saying, yeah, I'm more certain now. And yeah, he gives all the more reason to be, because like, look at the IWM, right? That's a crash. That's what that looks like, the very beginning of one. Big old area consolidation, most blatant that's ever been throughout history. We can put 2 and 2 together, guys. I believe in our competence. Just like honestly though, you know? Okay. All right. Okay. Now I'm gonna start getting into the investment part. What do we do in reaction to this? What are we gonna be doing with this information? All of this information. So, I want to show you guys what we can look to based off of history. And I went over this before, I'm just going to go over it again. Here's the state. So here's 224. That point right there. The 24th is really important. there is, we'll look at this, I'm gonna throw out a number there, it'll make sense in a second, 3% chance. There's a 3%, actually, thereabouts. 3% chance of this happening, that 24th. 3% chance. Okay, you ready? All right, lowest point of this downfall here, that's the lowest point. Okay, that crackdown, lowest point. Okay, keep that in mind. Let's go ahead and look at the Nasdaq during the .com crash. Oh yeah, it's touchscreen. I love that. Okay. Okay. So, let's go ahead. All right, so this is the top of the .com bubble. That's the top of the .com bubble. Here's that crackdown, that initial crackdown. That day right there, that lowest point of that first segment. It's the 24th. There's a 3% chance of that happening, right, on the 24th, and where we are right now, also on the 24th of that lowest point. There's a 3% chance. Take in mind the whole picture of everything that we've just gone over, knowing the system as it is, knowing that these people are extremely rich, very strategic, very powerful, and very incentivized to have a plan in mind and communicating it to each other implicitly, in the very least. 3% chance of this happening. So, that's what that looks like. Okay. The next part as well of looking at, when we look at this space off the .com bubble, this is the most similar bubble as well. This is why it's like, oh, of course. Because the .com bubble was tech-based, this bubble is as well tech-focused, all the same. It's also called the everything bubble because you also have like crypto and the housing market, NFTs, by the way, oh God, I just found an article. I found this again. I've seen several of these guys. There's a story out there of a 13-year-old girl becoming a millionaire in 1 year based off selling her NFTs. Yeah, that is how you cause sensationalism and obsession. And tricking a lot of people, just like the same thing with the tulip bulb, we can look at that. That thing was crazy. That thing spiked so hard so quickly and then it just crashed instantly. We're looking at NFTs. They're completely like unregulated. Yeah, don't get into NFTs. Please don't. Not right now anyways. In the years to come, maybe, but not right now. So looking at what happened for the .com bubble, and I'll show you guys what this looks like. Again, yeah, all right. What it looked like, I'll just tell you. What it looked like was that it was 717, right, from 224, that lowest point, just keep that in mind, right, to 717, that was the top of that second segment that came in, right, after that initial crackdown, that second segment, that top happened at 717, right? So based off that, knowing that we're falling to the freaking day, and then also we're like the most similar to that bubble, I've outlined here 419. Now, here's the funny thing, guys. Check out this. The 17th, right? 717, because remember, we're doing it to the day, right? It's kind of strange too, right? That we're doing it, you know, so to the day. And you look at the 17th here, this is on a Sunday. Guys, the market isn't open on Sundays. Here's the 18th, that's the closest. Now tell me something. Why is it, and this has been happening the last couple of weeks, why is it this never, by the way, this has never happened before. I've been using this thing for a while now. It's never been like this, on anything. You see that? You see the 16th here, right there? And it skips to the 19th. It is 1 day ahead of what it should be. The 17th isn't open for the stock market. It's 1 day ahead. The 19th, the 18th here doesn't exist. And yet it's a Monday, and there's no holiday there. It's been happening for the last couple weeks. So there's that. So we also are, by the way, in earnings right now, and again, nothing's for certain, but I would be thinking, staying in line with what's been happening and with history, that with earnings, it'll start out really strong over next week, and we'll see ourselves shoot up real quick, just like here, sort of thing, like that sort of movement, like we just did. It'll happen here, and you'll find yourself on the 18th, not the 19th, but on the 18th, you'll find yourself above this point, because that's what happened during the .com bubble. And by the way, it like mapped this like exactly, like like this. I can show you the technical analysis, but like it's identical. Just about. This part not so much, but it's there. Anyway, so I wouldn't be surprised if it were to be the top then, because of like earnings, and then just like from there. But we'll see. We'll see what happens. But that's sort of the idea. So there's that. So now you have like an idea about like a certain like range as well, which is sort of the point. I say 215, just based off of technical analysis, looking at like support lines and such. 215, thereabouts, just an idea. And yeah, this is that point right there. The day after Sunday is repeatedly off by 1 day forward. Conspiracy to imply the 17th to the 18th discrepancy. Anyway, so but yeah, maybe like 215. It's an idea. Regardless, though, thereabouts, I would say, and of course, spread this over like a couple of weeks. That'd probably be a good idea. You know, like maybe next week. Maybe not so much like right now. I would probably want to wait until the middle of next week, but thereafter, like just in this range, and the week after that, spread it over. And I would say that you would want to, just as an idea, right? Not financial advice, right? But to have like little bits around those days, and then like the 18th, 19th, or something like that, have like most of the investments going on onto those days, so to speak. But also like, you want to see it line up into this area, you know, but it probably will. We'll see. We'll see what happens. As the situation evolves, we'll continue the conversation. Yeah, okay. All right. So, yeah. So what to invest in? What to invest in? I looked at, so this is through so many hours of research. Looking through probably honestly a couple hundred of these things, of those things that would be best to invest in for the market crash based off of what has happened before. And the best one I found was this one, HIBS. And there's a couple other good ones too, but this one would be the best one. There were other ones that did like anywhere from like 2.5 times to 3.5 times during the COVID crash. This one did 4 times. This is the one that I would recommend, not financial advice. This is what I would recommend though. But a part of the investments into this, just like buying shares of it, right, is call options. And we're going to be going over call options now. The reason, you know, why we're involving these things to maximize the profits, and I'll show you what it looks like too. But we'll be going over those sorts of ideas now. Okay, let's get into options. And again, just HIBS. That's what it is. Directs you on daily SP 500. It's called high beta. It's just more volatility, so to speak. In other words, the ones that are like the most, you know, most able to and like probably going to swing, so to speak. This is what that one takes advantage of. So that's what I would recommend, but not financial advice. Okay. All right, let's go ahead and turn back over to here. Let's talk about options. Again, it's at like $8 now. Went down to $7. Wouldn't be surprised if it went back down to that sort of thing. $7 a share. Not crazy at all. It's wild. Very inexpensive, so to speak. Even now, then you can get you know, fractions of shares and stuff. Even if you were to look at like, here's Amazon, it's like $3,000. Yeah. Okay. So in this part, next week we'll be going a little more in depth into at least like going back over, so to speak, what we're talking about here, but just like more applied. But in this case, though, because we have time, don't need to really rush things. I'm just going to be going over the basics of options. What options are. So now there's more to this for sure. There's like theta and beta and all that sort of stuff. You don't really need to worry about that. I'm going to be explaining why. but in this part at least to understand what is an option, you know. So let's go over those parts. So there are two different kinds of options. There are calls, and then there are puts. Okay. If you want to have like a mnemonic device, during roll call, how does your hand go? It goes up. During roll call, your hand goes up. When you're putting something somewhere, you're putting it down. You put it down. Anyways, so if you haven't figured it out already, calls, you're just basically betting on it going up. Puts are when you're betting it on it going down. For our purposes here, the only thing that really matters is a call, and specifically a long call. A long call really just means that you're buying it. Like you're buying it and you're like, yeah, it's gonna like go up. You know what I mean? We're also gonna be selling it later on, but that's just, don't worry about that so much so right now, because again, that's like months out. But just long call, it just means, I bought a call. Or just like, I short a call on, you know. So it has to do with shorting, don't worry about it. It's totally fine. Different conversation. So that is a call versus a put. Now we also have something called a strike price. So a strike price is probably a really significant part of like an option, right? So with the strike price, how it functions is, it'd probably be best with like an example. So let's do a call for like SPY, right? The S&P 500 ETF, you know, your SPY, right? And we're getting a call on that, and the strike price is like, oh god, what is even the SPY at right now? It's like 360 or something. It doesn't really matter. Anyways, here's 360. So here's 360, right? That's our strike price. Okay. Now, what this means is that, and it's in the context as well as the expiration date. We'll get into that in a second. But what this just simply means is I have a right to buy SPY, right, at this price. And options, by the way, they function as 100 shares. That's how they function. So what I mean by that is like, I have one call. Cool. You have the right to buy SPY at 360 for one share times 100 now. You have the right to buy 100 of these shares of SPY at 360, right? And of course, if you're doing a call, you're like, well, yeah, but SPY's like gonna go up to like, I don't know, 380 or something like that. It's like, nice. You know what I just did? I bought a call, and there's parts to it. There's intrinsic, extrinsic value. We'll be going over that in a second. Just saying like preface, but hold off on that in a second as well. Don't get confused too much. Here's a call. I have an option. Later on, it goes to 380. Guess what I do? I go ahead and exercise my option. I exercise it, right? And I use it. I'm like, I want it. You got 100 shares now at 360. Bam! Sell it immediately. Made money. That's how that works. So let's go over the okay. So the other part to it is that we have something called an expiration date. Okay. What an expiration date is let's say you buy a call, right, for SPY, strike price at 360, you know, and you're hoping it goes up. The expiration date is, if we're in April right now, wait, are we in April? What fucking month is it?
Yeah, it's April.
Yeah,
It's almost 420.
Yeah. God, I'm just losing my mind. Okay. Fucking stock market got me all fucked up. What fucking year is it? Alright. So we're in April. Let's say you get a call, strike price, right, 360, and you're saying like, okay, I'm gonna give myself a few months here of room because because, you know, hey, maybe the SPY goes like that, right, sideways for a little bit. I want more room for it, right? It'll make sense in a second. I want more room for it because I want to make sure that it has as much time as it needs in order to go actually up so that it's worthwhile, right? So the expiration date here for your option, the expiration, because it expires, the expiration date is, I don't know, November, right? November of 2022, right? 2022. What happens in November of 22? And you'll have like a week to this. It'll be like November 8th or some shit. What happens here is that if you go to this and you haven't exercised it, you haven't sold it, you haven't done anything with it, it instantly becomes nothing. It is worthless, expires, you no longer have anything here, you've just burned money. Don't worry about that. You're not going to ever have to worry about that in this context because we're not ever going to be waiting around for the expiration date. That'd be nutty. And you don't even have to worry about trying to exercise it actually, too, because you don't want to do that. Reason why? Reason why is because there's something called intrinsic and extrinsic value to options, okay? The intrinsic value to an option is based off of, just write this down. All right, cool. Now, the intrinsic value of an option is based off of, like, if I were to do this now, exercise it right now, what could I get? Well, let's say, like, you know, I don't know, a couple days after that 361, it goes up to 365 or something like that. That worth of $5 times 100, which is $500, right? Again, remember, every single option counts for 100 shares. That's just how they function, 100 shares. So whatever the difference in prices between, like, the underlying security, what you bought of SPY, again, $5 difference times 100. That's just how they work, right? That $500 value is factored into the price, the worth, really, of the option. And that's called intrinsic value, because if I were to do it now, what would it be? Extrinsic value is based off of some complicated shit. But in a nutshell, it just means, like, but what could it be worth? What could it